You know, uh, Lately, when you hear a company throw around the term AI, it feels a bit like corporate fairy
Oh,
dust.
absolutely. It's totally become this, shiny object.
Right. A CEO just kind of sprinkles it onto a quarterly earnings report, mentions machine learning a few times, maybe throws in a reference to neural networks.
Yeah, and they just cross their fingers hoping the stock price gets a nice little algorithmic bump from it.
Exactly.
It's really an expectation from Wall Street at this point, rather than a, factual description of the day-to-day plumbing of a business.
Right, because everyone wants to say they're an AI company.
But very few actually want to do the really unglamorous work of rebuilding their entire infrastructure.
Which makes our mission for you today so compelling. Welcome to the deep dive. We are tearing into the Q1 2026 earnings call transcripts from the leadership of Lemonade.
Specifically, the remarks from their CEO, Daniel Schreiber, their president, Shai Wininger, and their CFO, Tim Bixby.
Yeah, we're looking at a company that claims to have built its entire foundation, the literal core operating system of its business on artificial intelligence from day one.
Right.
And suddenly, that fairy dust is supposed to be doing the heavy lifting of a Fortune 500 company.
And honestly, whether you're an investor tracking the insurance sector or, a tech enthusiast fascinated by automation.
Or just curious learner trying to understand how artificial intelligence actually translates into hard dollars and cents.
Exactly. This is a masterclass.
Yeah.
Because Lemonade is publicly claiming to do what so many companies are only, pretending to do right now.
Which is?
They say they're using AI to simultaneously hyperscale their business and fundamentally slash their operational costs.
And so we're moving past the tech buzzwords today to see if the financial reality actually matches the hype.
Right.
And to really grasp what happened in their Q1 performance, we have to start by looking at their growth numbers.
Because they are incredibly aggressive.
Yeah, their in-force premium, which they call IFP, basically the annualized total of all the active premium dollars they're collecting from customers, it reached $1.33 billion.
Wow.
Yeah, growing 32% year over year. And this isn't some sudden, pandemic-fueled spike. This is their 10th consecutive quarter of accelerating growth.
I mean, any 10th consecutive quarter of accelerated growth is going to turn heads.
Oh, right.
But the part that should really make anyone who studies business scaling pause is their marketing spend.
Oh, right.
Since the first quarter of 2023, Lemonade has grown their marketing spend by roughly 200%.
Wait, if you dump that much fuel on the fire, your efficiency almost always tanks?
Really, yeah.
Because the universal rule of customer acquisition is that the easy customers are cheap, and the more you spend, the harder it gets.
Right. You inevitably start buying more expensive, less effective ads just to keep the growth engine fed.
So are you telling me they tripled their ad spend and didn't see a massive drop in return on investment?
What's fascinating here is how this breaks conventional business wisdom. Lemonade is just defying gravity.
How so?
Despite that 200% increase in marketing spend, they're maintaining a lifetime value to customer acquisition cost ratio, their LTV to CAC, above 3.
Okay, let's unpack this. Because a 3-to-1 ratio means for every dollar they spend convincing you to download their app and sign up, they are making $3 in profit over the life of your relationship with them.
Exactly.
Maintaining that kind of margin while scaling spend by 200% is, well, it's practically unheard of. How is that mathematically possible when ad fatigue is just a universal reality?
Well, the management team credits a proprietary internal system they call LTV AI for this gravity-defying act.
LTV AI.
Yeah, and this isn't just an algorithm that sets a daily budget on Facebook or Google. This AI dynamically allocates their marketing capital across different channels, different insurance products, and different geographies.
He's constantly maximizing return.
Exactly. It evaluates the potential lifetime value of the specific customer pool it's targeting in real time.
So if the AI sees that acquiring a renter in Chicago is suddenly getting too expensive.
It instantly pivots those dollars to acquiring pet insurance customers in Austin, where the margin is temporarily better.
Oh, wow.
Yeah, they aren't guessing where the ads work best. The system is actively hunting for the highest return on investment, millisecond by millisecond.
And the efficiency isn't just contained to the marketing department, it's showing up in the human workforce too, which is kind of the ultimate test of AI replacing manual labor.
Yeah, the human capital side is wild.
They just hit a massive milestone, over $1 million of in-force premium generated per single employee.
That's huge.
It's a nearly 3 times improvement over the last 4 years. Meanwhile, their actual human headcount only increased by a tiny 2%, sitting at just 1,291 employees.
Which is incredible.
Right. To put this in perspective, think about a bloated legacy corporate insurance office. You have floors and floors of slow-moving paper pushers.
Manual underwriters.
Yeah, and hundreds of human claims adjusters sitting in cubicles. Lemonade has effectively replaced that entire army with a very small elite strike team backed up by a massive lightning-fast server farm.
And that's because 10 years of investment into a single proprietary, vertically integrated AI system is now visible on pretty much every line of their profit and loss statement.
They're scaling the revenue up by hundreds of millions of dollars without bloating their salary expense base.
Which is the purest definition of operating leverage.
But if this automated strike team approach is working so beautifully and, making them so obscenely efficient, what is stopping Google or Amazon or some deep-pocketed private equity firm from crushing them?
It's a fair question.
Right, because during the earnings call, a retail investor named Andy Kay asked this exact question directly to the president, Shai Wininger.
Oh, right, the copycat question.
Yeah, and to know what prevents a competitor who launches tomorrow, equipped with unlimited compute power and the absolute latest cutting-edge AI models, from copying this playbook and catching up in a couple of years.
Which, the threat of the deep-pocketed copycat is the ultimate stress test for any tech company.
Definitely.
And Shai's response was incredibly revealing about the nature of AI in highly regulated, complex industries.
What did he say?
Well, Lemonade's defense isn't just about having access to the coolest, newest AI tools from OpenAI or Anthropic.
Right.
It's about a decade of what he called compounding execution and an AI-first architecture.
Let's dig into that, because I think people assume AI is just magic out of the box.
Oh, complete.
But commercial AI models, no matter how advanced, no matter how many hundreds of billions of parameters they have, they cannot price an insurance policy on their own.
No, not at all.
Large language models can write a brilliant sonnet in the style of Shakespeare or summarize a dense legal contract.
Right. They're great at text.
But underwriting risk requires statistical models that are trained on highly specific, massive, real-world historical data set.
Exactly. You have to actually know how often pipes burst in specific zip codes in Minnesota in February.
Yes. Or how often a French bulldog gets a specific type of stomach issue at age 4.
And the tech industry has a real blind spot when it comes to foundation models, assuming they could just solve any problem out of the gate.
Right.
But underwriting is a predictive math problem based on human behavior and physical realities over time.
I keep thinking of this analogy. It's like a tech billionaire who decides to build the most state-of-the-art high-tech commercial kitchen in the entire world.
Okay, I like where this is going.
They spend $1 billion on the best induction ovens, the sharpest robotic knives, and unlimited electricity. But if they don't have any raw ingredients...
And no recipes.
Right. If they don't have a single recipe, and if they don't even know what the customers in that specific neighborhood actually like to eat, they still can't bake a cake.
Yeah.
The cutting-edge technology alone is entirely useless without the historical context.
And in the business world, we call that a data moat.
A data moat, yeah.
Because time is the one single asset that a competitor, no matter how rich they are, cannot simply purchase.
Wow, that's a great point.
A new entrant into the insurance space starts at zero. They have zero historical claims data, zero brand trust, and zero production-validated models to train their algorithms on.
And zero regulatory approvals. Shai made a huge point about navigating complex regulatory environments.
Oh, the regulations are a nightmare.
Right. In the U.S. alone, insurance is heavily regulated state by state. You cannot just code an algorithm, flip a switch on a server, and sell insurance everywhere.
Definitely not.
It takes years of grinding through bureaucratic red tape to get your pricing algorithms legally approved by local departments of insurance.
So while a new startup with $1 billion in funding spends 3 years just trying to get their legal approvals and gather their very first bits of data.
Well, Lemonade is just pulling further ahead.
Exactly. Lemonade's head start means its systems keep learning from millions of interactions, keep iterating their pricing, and keep accelerating.
So the gap constantly widens.
Yeah, the gap between Lemonade and a new copycat constantly widens because data compounding is exponential, not linear.
Okay, so we understand how they are selling so efficiently this compounding data moat combined with an AI architecture.
Right.
But if their marketing AI is so smart, it begs the question, What is it actually choosing to sell to fuel this hypergrowth? And honestly, looking at the transcripts, this blew my mind.
Oh, the product mix.
Yeah, the star of the show, the rocket ship of their product line right now is pets.
It's wild, but yeah, pet insurance is now Lemonade's largest single line of business.
Unbelievable.
They just reached a massive milestone, hitting $500 million in in-force premium just from cats and dogs.
Just cats and dogs.
Yeah, it's the very first product in their entire portfolio
Yeah.
to cross that $500 million mark.
And they did this in less than 6 years from launching the product. They're now the most searched pet insurance brand in the U.S. and the fourth largest carrier overall.
Fourth largest already.
Right. They're competing against legacy incumbents that have decades of operating history in the pet space, and they are dominating. But why pets? Why does the AI prefer to sell that specific product?
Well, the answer lies in the nature of the claims themselves. Pet claims are inherently high frequency but low severity.
Meaning, you take your dog to the vet a lot for ear infections or minor cuts, which generate relatively small bills, maybe $100 here, $200 there.
Right.
Compare that to homeowners insurance, where a house burning down is incredibly rare, but when it happens, it costs hundreds of thousands of dollars.
Exactly. And high-frequency, low-severity claims are the absolute perfect candidates for end-to-end AI automation.
How so?
Think about the friction in the legacy insurance model. In the old world, a human adjuster has to spend 20 minutes reviewing a $150 handwritten vet bill for antibiotics.
Checking the policy limits, cutting a check.
Yeah, and the human labor ends up costing almost as much as the payout.
Wow.
But with Lemonade, an AI instantly cross-references the digital medical code from the vet, verifies the exact policy limits, screens for fraud, and approves the payment in roughly 3 seconds.
3 seconds. That is a massive structural expense advantage over peers who still rely on human call centers and manual processing.
Huge advantage.
But here's where it gets really interesting, though. It's not just about acquiring brand new pet owners off the street through expensive ads.
Right, the cross-selling.
Yeah, Shine noted that 85% of their current pet in-force premium was sourced entirely from their existing customer base.
85%.
They already have over 3 million active customers using their app for things like renter's insurance, and they're cross-selling pet insurance directly to them through the interface.
And if we connect this to the bigger picture, you have to realize that those cross-sales are functionally CAC-free.
Customer acquisition cost is basically zero.
Practically zero, yeah, because the user already has the Lemonade app installed on their phone, their credit card is already on file, and they already trust the brand.
Right, a push notification costs nothing compared to a Google search ad. Which brings up a really fascinating moment from the Q&A portion of the earnings call. A retail investor who goes by the handle Paperbag asked about this exact cross-selling strategy.
Oh, yeah, Paperbag's question.
Paperbag pointed out that currently, only about 5% of Lemonade's total customers are multi-line.
Meaning they hold more than one type of policy.
Right, like having both renters and pet insurance. And I saw that 5% number and immediately thought, wait, that sounds really low. That sounds like an abject failure of the cross-sell strategy.
I mean, it does sound surprisingly low on the surface. But the CFO, Tim Bixby, answered that question, and the underlying math completely flips the perspective.
Yes. Tim pointed out that while it is only 5% of the total human customer count, if you look at the actual dollar value, that tiny 5% of bundled customers accounts for a massive 18% of their total in-force premium.
It's crazy.
That small group is punching way, way above its weight class in terms of generating revenue.
And that is the power of the bundle. When you have an existing base of 3 million customers, convincing just a fraction of them to buy a second or third policy dramatically spikes their individual lifetime value.
Right.
And again, because the marketing cost to sell that second policy was functionally zero, the overall profit margin on that specific bundled customer skyrockets.
And Shai actually mentioned that this high lifetime value gives their growth team a literal superpower in the marketplace.
How so?
Because the back-end value of a bundled customer is so incredibly high, Lemonade can afford to increase their allowable CAC.
Oh.
Meaning they can confidently spend more money outbidding their legacy competitors on ad platforms to acquire brand new single policy customers.
Because they know they have the cross-sell engine to monetize them later.
Exactly, while still safely maintaining that magic 3-to-1 overall efficiency ratio. It's a self-feeding growth loop.
It really is a brilliantly calibrated machine. However, growth algorithms and pet policies make for a fantastic tech narrative, but we can't ignore reality.
Insurance is fundamentally about managing real-world risk.
Mm.
If you price risk wrong or take on too much bad risk, you don't just have a bad quarter where your stock dips.
You go bankrupt,
Exactly.
which is the perfect pivot. Let's look at the actual financial bottom line, see if it reflects this optimistic narrative, or if the tech overhead is eating all the profits.
Let's do it.
Revenue grew a staggering 71% to $258 million.
Wow.
Now, Tim did clarify that this revenue jump was technically boosted by a recent reinsurance transition, which basically resulted in Lemonade keeping more of their own premiums rather than passing them off to backers. But still, 71% top-line growth is massive.
Yeah, and gross profit spiked even harder, up 159% to $100 million.
Huge jump.
And their adjusted gross margins are sitting at a very healthy 39%.
But on the loss side, which is the money they actually have to pay out to customers for accidents, their gross loss ratio was 62%. Tim noted that this 62% included a 5% CTAT impact.
CTAT meaning catastrophe, things like massive winter storms, hurricanes, or wildfires.
Mostly winter storms in Q1 for them. But that 5% hit was somewhat offset by 3% in what they call favorable prior period development.
Which is insurance speak for.
Basically, the older claims from previous quarters that they had already budgeted for actually cost 3% less to settle than their AI initially expected.
Okay. And when you look at the ultimate bottom line, the adjusted EBITDA loss, which is basically their operational cash burn, shrank by 64%.
Down to just a $17 million loss for the quarter.
Right. Furthermore, their adjusted free cash flow actually crossed into positive territory at $17 million.
Oh, wow.
And management reiterated their firm expectation to hit sustained positive EBITDA by Q4 of this year and for the full year of 2027.
So what does this all mean? When you look at all these incredibly positive growth and efficiency numbers, there is one major metric sitting in the middle of the report that seems completely stuck in the mud.
The retention.
The ADR, or annual dollar retention. This metric measures how many premium dollars from a group of customers a year ago are still with the company today. That number was totally flat at 85%.
Yeah, and Wall Street analysts notoriously hate flat retention.
They really do.
They want to see that number constantly ticking up, proving that the product is sticky and customers aren't churning.
But this raises an important question about the tension between protecting the business and pleasing Wall Street.
Right.
Because that flat retention rate isn't an accident, and it isn't a failure of the product, it's the direct result of a deliberate internal initiative management calls clean the book.
And when I read about this, I couldn't believe it.
It's pretty bold.
Tim explained that Lemonade has been actively and purposely non-renewing certain policies in their homeowners line to aggressively reduce their catastrophe exposure.
They're intentionally firing their own paying customers.
Kicking them off the platform, yeah, if those specific homes happen to be in geographical areas that are increasingly prone to severe weather events.
And this is where executive leadership has to make incredibly tough, unpopular choices.
Absolutely.
Purposely shedding revenue and kicking customers to the curb makes your retention numbers look stagnant or even worse on paper.
It creates an immediate visible headwind for the ADR metric that analysts track so closely.
You risk getting crushed in the financial press for slowing down, but logically, it's a brilliant, proactive survival move.
Exactly that. It proves that leadership is willing to take a temporary PR hit on a highly scrutinized, public-facing metric to ensure the long-term solvency of the business.
Right, because you do not want to hold onto a homeowner's policy just to pad your retention stats.
If that specific customer represents a massive, unpredictable wildfire risk that could blow up your entire quarterly loss ratio overnight.
Shea backed this up with a great data point, actually. He noted that if you actually exclude the homeowner's line entirely from the math, the retention rate for the rest of the business actually improved by 300 basis points year over year.
Oh, nice.
So the core business, the renters and the pets, is getting noticeably stickier. They're just surgically cutting out the weather-exposed rot.
They also pointed out a structural advantage here. Cross-sold, bundled business like a renter who lives in a concrete apartment building, adding a pet policy, is largely acquired with zero catastrophe exposure.
Oh, that makes sense.
Right, an apartment fire doesn't cost Lemonade the building, those are contents. And a sick dog isn't affected by a hurricane.
Exactly.
So as that bundled segment grows to 18% of the pie and beyond, It fundamentally hardens the overall stability of the entire company against climate change.
And they have a massive war chest to see this transition through. They're sitting on roughly $1.1 billion in cash and investments.
That's a lot of runway.
Yeah. They noted their growth spend for the year will be about $235 million, and their stock compensation will be around $95 million, which is largely driven by multi-year equity grants previously given to the two founders.
It's definitely worth watching how the market is reacting to this long-term stabilization strategy. The investor relations team has clearly been busy.
Yeah, institutional ownership excluding SoftBank, which was an early major backer, has increased by over 50% in the last couple of years.
50%.
Major institutions are quietly initiating new positions, which strongly suggests the smart money is buying into this methodical path to profitability.
So to bring this all together and summarize the massive amount of ground we've covered today.
Lemonade isn't just sprinkling AI fairy dust on an earnings report.
Right.
They're leveraging a very real 10-year algorithmic head start to fundamentally decouple their business growth from their human headcount.
They're achieving this by automating high-frequency claims like pet insurance.
Using their marketing AI to aggressively cross-sell to an existing base of 3 million customers at zero acquisition cost.
And having the discipline to purposely shed risky, weather-exposed home policies.
All of these levers are pushing them confidently toward actual profitability by the fourth quarter of this year.
It paints a very clear, data-backed picture of their strategy. But it leaves you with something much deeper to consider as you watch this sector evolve.
What's that?
If a tech-first company like Lemonade fundamentally relies on a decade of compounding data, localized algorithmic training, and state-by-state regulatory learning to build an uncopyable AI moat today,
Yeah.
what is the ultimate fate of traditional legacy insurers over the next decade?
Oh, wow.
Will those 100-year-old incumbents become entirely obsolete because they completely lack this foundational, vertically integrated AI architecture?
Or will we see them forced into a frantic wave of massive tech acquisitions, buying up smaller AI startups at huge premiums just to survive the transition? That is the multi-billion-dollar question hovering over the entire financial sector right now. It turns out you can't just buy a shiny new algorithm, slap it on a century-old business model, and expect it to magically scale.
You actually have to build the plumbing from the ground up.
Thank you for joining us for this deep dive. Keep questioning the data behind the headlines, look for the moats, and we will catch you next time.